Hello, this is a brief video describing the 401k retirement plan that's available to the employees of Rolling Dough Enterprises and Burger Barons LLC. There are a few pieces of information that are available to you through the restaurants. You can ask your general manager to print these items up for you. And it's pretty much what I'm working off of for the purposes of this video. For starters, there's an information page that describes everything you would need to know about the 401k plan, and that's what I'm going to be utilizing as I describe the plan throughout this video. There's also a list of all the different funds that are available for you to invest the money into. In addition, there is a sheet that shows the most recent performance numbers of the various funds. And there's even some sample allocations, suggestions based on what type of approach you want to take, which percentage you would put into the various funds. These are just suggestions. And then, of course, the enrollment form, which we're going to go over in detail a little bit later in this video. So for starters, I should probably tell you that this is not financial advice, that everything you hear here in this video is simply a description of the 401k plan that we offer in our company. If you need financial advice of any kind, you will want to seek that advice from a financial professional or a financial advisor. Nothing in this video is meant to be financial advice. So for starters, let's talk about what a 401k plan is. Many of you may not be familiar with a 401k plan. It is basically a retirement plan that's offered by an employer. You get to decide how much of your salary you want to contribute, and the employer will deduct that amount from your paycheck and invest it on your behalf into various assets that you will select based on whatever it is that employer makes available. And in many cases, employers will match a portion of the money you contribute to give you even more money. And we do match, so we'll be touching base on that a little bit later in this video as well. So as far as how our company 401k works, we offer two options. One is a pre-tax option, which we refer to as a traditional 401k, as well as an after-tax option, which we call a Roth 401k. Both of those options are available to you. You would pay no federal income tax on any pre-tax 401k contributions that you make or their earnings until you remove the money from your account. On a Roth 401k, those contributions are deducted from your check after taxes are already paid. But you will not have to pay taxes on them or their earnings when you remove that money from the account, as long as you don't remove the money until after age 59 and a half. As far as who's eligible to enroll or participate in the 401k plan, as long as you are 21 years or older, you've been employed for at least a year and have worked at least 1,000 hours during that year, then you are eligible to enroll in the 401k plan. Entry dates into the plan are basically the first day of each quarter, January 1st, April 1st, July 1st, and October 1st. And normally the month before those dates, we call that an enrollment period, and you can send in forms anytime during that month. As far as contributions is the term we use for the money that you put into the plan, that it's deducted from your paycheck and it goes into your plan. You can make both pre-tax and Roth after-tax contributions from your paycheck, anywhere from 1% of your wages up to a total of $18,000. That is the IRS indexed amount for this calendar year. You cannot contribute more than that. Now, if you are age 50 or older, they do allow you to make an additional catch-up contribution of $6,000 for the year. You may change your contribution percentage 4 times a year. We mentioned those dates just a moment ago, and those are the dates that you can change the percentage of your salary that you are contributing into the plan. You may stop your contributions at any time, and you can re-enter the plan on any pay period. And the company makes discretionary matching contributions every pay period. That match is currently 50 cents on the dollar for the first 3% of your pay, or 50% of the first 3% of your pay that you contribute to the plan. I thought it would be best to demonstrate this a little bit, so I've done that on the next slide here. So for the purposes of just having a simple example, we're going to say that annual salary is $26,000. Now we have 26 pay periods per year, so if we were to divide that up, that would mean that each paycheck you're earning about $1,000. Now if you're not on a salary, if you're an employee who punches in and out every day and your checks vary from pay period to pay period, well, you can sort of estimate what your salary is by looking at last year's W-2 or just doing the math, estimating how many hours you think you're going to work on a weekly basis. So for the case of this example, $1,000 per paycheck, if we decided we were only going to contribute 3% of our salary, then that would be, as you can see there, that'd be $30 a paycheck. So every paycheck, $30 would be deducted, and it would go into my 401k account. Now I can contribute more than 3% or less than 3%, but for this example, we're going to do 3%. Now the company is going to match 50% of that first 3%. So since that first 3% equals $30, the company is going to match half of that and is going to add an additional $15 into your 401k. So now your $30 contribution has just become $45. And it doesn't seem like a lot, but over the course of the year, that's $390 of free money, basically. And you got to keep in mind that a 401k plan is meant to be a long-term savings plan towards your retirement. So that's 1 year, imagine 10 years or 15 years. And that's the way the matching works. Now, if you were to contribute more than 3%, the company would still only match half of the first 3%, nothing beyond that. So let's talk about vesting. The vested portion of your 401k is the part that belongs to you, and it cannot be lost if you were to leave your job. Now, the money that you contribute, the money that you select on the form that you want to come out of your paycheck and go into your 401k, that, of course, is always 100% vested, meaning that it always belongs to you. We would never take that money away from you. But the contributions that the company makes are subject to a vesting requirement. And this simply means that over time, you earn a larger and larger percentage of those contributions that the company has made during the matching process. And here is sort of the schedule that goes by. After 2 years of employment, those contributions, 30% are vested. So 30% of those contributions belong to you. After the 3rd year of employment, that percentage goes up to 60%. And after 4 years of employment, you are 100% vested in those contributions as well as your own. So they would belong to you entirely if you were to reach a retirement age or leave the company. Another benefit of the 401k plan that we offer is that you can borrow against your account if you ever needed to. Now, the minimum loan amount is $1,000, and you can borrow up to 50% of your vested account balance. So pretty much you would need to have $2,000 in the account minimum in order to have any type of loan. The maximum non-residential loan term is 5 years. There is a $185 loan administration fee, and you would repay those loans through payroll deduction. So you would select the loan term, anywhere from 1 to 5 years, and then they would compute the payments. The interest rate you would pay is prime plus 1, and then you would begin seeing those payroll deductions come out of your check, and those payroll deductions would go right back into your 401k with interest. So you're basically paying yourself back with interest. You can only have one loan out at a time. So once you've taken a loan out, it must be paid in full before you can take out another loan. So once that money, you decide how much you'd like to contribute to your 401k. And once that money comes out, it's going to be invested in funds. There's quite a variety of funds that are offered under this 401k plan, and you get to select which funds you invest in. You can invest in any combination of these funds, and in as many of them as you want, or as few of them as you want. And you can change those investments daily. There's a number you can call there on the screen. You can also go online and change the investments through their website. I won't go through all these, but this is a list of the various funds that we offer. The capital letters you see to the right of each name in parentheses are the ticker symbol, which you could punch into a website and be able to see the performance of those funds. Now, each of these companies has their own website, which you could go and learn more information about these funds. Or Morningstar.com is a popular choice of where you could go and enter those ticker symbols, and it would show you various details about the fund as well as how that fund has performed over time. And there's the other half of that list. That list is available as one of those papers I showed you earlier. You can get those from the general manager at your restaurant. Now, when you take money out of your 401k, it is called a distribution. You can withdraw money out of your account for any of the following reasons. So, for starters, the 401k is designed for retirement. So once you reach age 59 and a half, you can take the money out of that account for any reason. But if you're under 59 and a half, there is a way you can take money out of the account for IRS financial hardship reasons. Those would include college, buying a home, any major home repairs, as long as the IRS Section 165 casualty deduction definitions apply to it, preventing eviction or foreclosure, medical costs, or family burial funeral costs. Also, retirement, termination of employment, death, or total disability would allow that money to be removed as well. So enrolling, I wanted to go through the enrollment form so you would know exactly what you need to complete. So what you see here is the very first section of the form. Section 1 simply lists the name of the plan. It's already on the form. And Section 2 is just your basic information. I don't think there's any explanation that's needed there, but it does need to be filled out in its entirety. Now, Section 3 of the form is where you're going to determine how much or what percentage of your pay you would like to contribute to the 401k plan. For starters, you select the regular 401k, which is your pre-tax deductions, or your Roth 401k, which is the after-tax deductions. Now, you can pick both if you'd like. You could do a percentage into one and a percentage into the other at the same time if you chose to do that. And you can see there's also a place where you could do a dollar amount instead. So if you'd rather do a set dollar amount coming out of each paycheck into one or the other or both of these types of 401ks, you're welcome to do that as well. But you do need to fill out one or the other, either a percentage or a dollar amount of either one or both of these 401k plans. Then, of course, if you do not wish to contribute, you would check that bottom line. Now, Section 4 is where you're going to pick the different funds that you're going to contribute. Now, you could pick as few as one, and you could even pick all of them. The key is that the percentage you're going to put in each fund and the total of all those percentages must equal 100%. So if I were going to put 100% in Federal Capital Preservation Fund, then I would meet the requirement of those percentages totaling to 100%. Or maybe I decide I'm going to put 50% in the Capital Appreciation T. Rowe Price Fund, and then I'm going to put the other 50% over here in the John Hancock Fund. Or maybe I want to do 4 funds where I could put 25% in each fund. Or maybe I want to do 10 funds where I'd put 10% in each of the 10 funds. Or I can put all different numbers of percentages in all different variety of the funds. But the key is the total of all the percentages I list on this form must equal 100%. Otherwise, it wouldn't make any sense. So very important that as you put those percentages, you understand they must total to 100%, and that you can put percentages next to as many of these as you'd like or as few of these as you'd like, as long as those percentages total to 100%. Lastly, on page 2 of the form, it does request a beneficiary. So, and that is the purpose that if something were to happen to you, then the money in the 401k would go to the beneficiary that you designate. Now, that beneficiary would normally be your spouse. So if you are married and you want to put a different person in the beneficiary spot, there is a signature of spouse line at the very bottom there, as you can see, and that is required. Now, if you are not married, you don't have to worry about that. But if you are married and you want your beneficiary to be someone other than your spouse, then your spouse will need to sign the bottom along with a witness. And that's the whole form. Of course, if you have more questions, I've listed a couple of numbers there on the form, on the screen, that you could contact to get additional information. And as always, you could ask your general manager for my information, and you can reach out to me, and I would be happy to help you as well. Thank you for your time, and have a great day.